this is Jim Pearce, Chief Investment Strategist for Personal Finance, with a weekly update on Friday, April 26, 2024. A week ago, I summarized the overall economy by stating right now the positives outweigh the negatives. That's still the case, but this week's gross domestic product and personal consumption expenditures numbers for the month of March were more negative than positive. During the first quarter of this year, GDP grew at an annual rate of 1.6%. That is less than half the 3.4% annual growth rate recorded during the previous quarter. In March, the PCE price index rose 2.7% on a year-over-year basis, compared to a 2.5% increase in February. Long story short, inflation is rising while the economy is decelerating. Now here's the GDP report, and if you look over here on the right, this far right figure is for the first quarter of this year. You can see it's slightly positive. You can see the one before it for the fourth quarter of last year is about twice as high. You can see the one before that for the third quarter of last year is even higher than that. So that's a trend, and it's going down. That's not good. It's still positive in that we're not having contraction. We're not, the economy is not shrinking, but nevertheless, it's growing at a decelerating rate. Then you come over here to the PCE report, and you come down here to the bottom right corner. PCE in the month of March on a year-over-year basis, here's the 2.7 figure I just mentioned, and you can see it grew at an annual rate of 2.5% in both February and January. You have to go all the way back to November until you get back to the 2.7 rate. So it looks like, right now it may have bottomed out during the first 2 months of this year and is starting to go back up. Hopefully those numbers are an aberration that will soon fall back into line. But if that trend continues into this month and beyond, Wall Street will start fearing the dreaded stagflation scenario that my colleague John Pearce describes in his daily recap this morning. And here's that article. I suggest you read it. For those of you that are younger and don't remember the 1970s, wasn't a great time for the economy. I was in high school and college then, and I can tell you that it was pretty brutal. And I graduated from college in 81, and John talks about the unemployment rate peaking at 10.8% in 1982. That was literally my very first year out of college, so I remember it well, and we do not want a repeat of that. Just take our word on that. Despite that unwelcome news, the stock market rallied this morning, so I'm going to show you first. Let's go back to just look at the major indexes here. Here's the S&P 500. I'm recording this right at noon, and the S&P 500 index is up 1.05%, so I'll show you that. Even the NASDAQ 100 index is up exactly 2%. That's good news. Now that's because Alphabet and Microsoft released strong Q1 results this morning that exceeded Wall Street's optimistic expectations. Those are two of the most valuable publicly traded companies in the world, so they exert outsized influence over all the cap-weighted indexes that include them. For that reason, a jump in the S&P 500 index and NASDAQ 100 index could be dismissed as not being indicative of the overall stock market. However, even the small cap Russell 2000 index is also up strongly this morning. So here's the Russell 2000. Now it's up 0.7 or so of 1%, not quite as much as the S&P 500, but even still, remember that the Russell 2000 excludes all those huge tech stocks that are so popular on Wall Street. So the fact that it's up 0.7 of 1% is a good sign. Also, the S&P 500 index on an equal weight basis is in positive territory today. So the bottom line is this. Wall Street is still bullish on the stock market despite the economy's uneven performance recently. There are two reasons for that. First, the consumer is still spending. That is the lifeblood of our economy, and so far it's holding up despite high interest rates. Second, most companies are meeting or exceeding their guidance for the first quarter of this year, and so long as those two trends remain in place, Wall Street should remain bullish on stocks. Perhaps the most unexpected response to this week's economic news was a slight drop in the yield on the 10-year Treasury note. It wasn't much of a decline from a high of 4.73% yesterday to a low of 4.65% today, but it's direction that counts. If bond traders believe that stagflation really was on the way, that yield would be going up instead of down. My outlook for the stock market has not changed. We may not gain any new ground over the next few months, but we shouldn't lose much ground either. I believe the major stock market indexes will trade in a relatively narrow range until there's more clarity over which way inflation is headed next. That's this week's PF report, and I look forward to talking to you in another week. Thank you.